This
Because
conference will
just
now
now we
be
have received
recorded.
the intimation about half an hour back that there is an extension for the tax audit returns and completion of the tax audits, which is extended up to 31st January 2021. So all of us with a cool minds in a digestive capacity will be in a position to envisage the ins and outs and intricate issues arising out of tax audit. I welcome one and all to our 20th webinar of the series. About our association, we have been having uh, the imparting and sharing of education has been the forte. And for this, we have been organizing study circle meetings, the budget meetings, and recently the webinar series. And now the webinar will become a normal for all of us, keeping in view what has been the atmosphere and environment around, which is a very disturbing feature. I welcome one and all to this meeting on critical aspects and amendments tax audit 2020, and I'm sure she will also talk about the amendments made to the form relevant to the new tax regime. It's over to Payal Maheshwari for introducing Ms. Jayna Shah, the speaker of the evening. Thank you one and all.
Good morning, good evening, everyone. Uh, our speaker for the day, CA Jayna Shah. She is an associate director with Khimji Kuvarji and Company. She is a chartered accountant with rich experience in delivering advisory and compliance services on direct tax, international tax, and transfer pricing matters across various industries. She has also contributed various articles to CVO CA monthly newsletters and CTC student journals Jignasa. I would like to welcome our speaker for the day, and over to you, CA Jaina.
Good evening, everyone. Thank you, Payal, for the introduction. And thank you to KDOC Association for this opportunity to discuss some of the critical aspects and amendments relating to tax audits. So to start with, I will begin with a background on tax audits and
Ma'am, can you
then
just start
discuss
your
some of
video?
the...
Sorry to interrupt.
Yes, sorry.
Thank
Yes.
you.
So to start with, I'll begin with the background on tax audits and then discuss some of the recent amendments to the to the Form 3CD, which were announced by the CBDT notification on 1st October 2020, and then discuss some of the critical aspects relating to various clauses of the 3CD. So the tax audit as such is mandated under Section 44AB of the Income Tax Act. In case the turnover of the assessee exceeds a certain prescribed limit, or if a particular percentage of the turnover is not offered as net profit in case of presumptive system of tax. The objective of a tax audit is multifold for the assessees as well as the tax authorities. So a tax audit ensures that proper maintenance of books of accounts and the relevant records in a manner such that the financial statements reflect the true and correct net profit. It helps in computing the correct taxable income of an assessee, since the eligibility and the quantum of various deductions or exemptions which are available to a taxpayer is certified by the tax auditor in the 3CD. So this helps in ensuring that the taxable income is computed correctly with the correct amount of deductions, and it also saves simultaneously saves a lot of time of the tax authorities as well, which they would otherwise spend in verifying all the claims made by an assessee. Tax audit is applicable in case of businesses, professions, and in certain cases of presumptive system of tax. In case of businesses, if your total sales, turnover, or gross receipts exceed 1 crore during the financial year, then a tax audit is mandatory. However, recently in the Finance Act 2020, the government has increased this limit of 1 crore to 5 crores, where the aggregate cash receipts and cash payments during the year do not exceed 5% of the total receipts and payments. So, in case of assessees where majority, 95% or more of the gross receipts uh, received through banking channels or through electronic modes, and if 95% of more of the payments are made through banking channels, then the limit of tax audit would be 5 crores. This is applicable immediately with effect from the current assessment year 2021, which is as such financial year 1920. Now, it is to be kept in mind that this is a cumulative limit. Both the receipts and payments have to be more than 95%, in more than 95% of both receipts and payments have to be through banking channels or through electronic modes. Only then this 5 crore limit would apply. In cases of profession, the total gross receipt, if the total gross receipts exceeds rupees 50 lakhs during a year, then tax audit is mandatory. For presumptive income under section 44AD, in case 5 years have not lapsed since the assessee opted for 44AD, and now the assessee wants to opt out of presumptive income, then and his income also, his taxable income exceeds the ceiling for chargeability of income tax. In such case, a tax audit would be mandatory for that assessee. For the other forms of presumptive income, such as 44ADA, which is for professionals, 44AE, 44BB, and 44BBB, which is for various non-residents, the tax audit is required if the assessee claims that his total income is less than the deemed profit as per that section. So, for example, if we claim that for 44AD, the deemed profit is 50% of the gross receipts. So, if the assessee claims that his taxable income is actually even less than 50% of the gross receipts, then a tax audit would be mandatory for that assessee. What is the due date for filing the tax audit report? Now, recently in Finance Act 2020, in order to facilitate the pre-filling of income tax returns, the tax audit due date was preponed by 1 month. So now the tax audits from this year onwards, from assessment year 2021 onwards, the tax audit deadline is 1 month prior to the due date of furnishing the income tax return for that year. So generally, if my if my return due date is 31st October, then my tax audit due date would be 30th September. And in case of transfer pricing assessees, if my return due date is 30th November, then my tax audit due date would be 31st October from assessment year 2021 onwards. Now, on account of this COVID situation in the country, the deadlines for tax audit have been extended. So earlier, 30th September due date, which was for assessees not subject to transfer pricing, was extended by 1 month to 31st October, which today, by the press release of the Ministry of Finance a couple of hours back, the due date has now been extended to 31st December 20 for tax audits and for all other audit reports, which have to be filed under the Income Tax Act. So the tax audit for all assessees has now been extended to 31st December 2020, even for those who are subject to transfer pricing. And likewise, the return deadline is extended to 31st Jan 2021. The CBDT will be issuing a notification to give effect to the press release shortly. Now, what are the various forms which are involved in the tax audit report? So a tax audit report comprises basically of an audit report by a chartered accountant in Form 3CA or Form 3CB. This is the uh, report of the auditor. So now Form 3CA is applicable in case the accounts have been audited under any other law. So basically, if your accounts have been audited under the Companies Law, under the Companies Act, then the tax auditor would issue a Form 3CA. In case the accounts have not been audited under any other law, for example, in case there has been a merger or a demerger and the effective date is falling during the current financial year, falling during financial year 1920, and but the implementation as such, the court order is of a later date, but the effective date of implementation of that merger is falling during the year. And if the accounts have already been finalized before that, without incorporating those the effect of the merger or the demerger, say, then those accounts would need to be prepared considering the effect of that merger, and as such, those accounts are not really audited under any law. They are not audited under the Companies Act, for example. So then the auditor would issue a Form 3CB where he would verify the and give an opinion on the true and correct, whether the financials are true and correct. So depending on whether the accounts have been audited under any other law or not, the Form 3CA or 3CB would be chosen. And annexed to that Form 3CA or 3CB, the audit report, you would annex the Form 3CD, which would give the particulars of various items. So now this Form 3CD is the responsibility of the management, and it is certified by the tax auditor. The tax auditor just issues the 3CA and 3CB. Now, in the tax, as regards the particulars in the 3CD, the tax auditor is required to give his opinion as to whether the particulars are true and correct. So in such case, the tax auditor would have to apply the generally accepted auditing procedures, apply the standards of auditing, use professional skill and judgment while deciding on various issues which come up during the tax audit. A tax auditor can also apply sampling techniques depending on the nature and volume of the transactions, the materiality involved, and the internal control procedures followed by that assessee. It is very important for the tax auditor to maintain all the necessary documentation and the evidence on which he has relied upon to give his opinion. Such as what was the work done by him, what are the explanations and information given by the assessee during the course of the audit, the decisions on various issues taken. There could be various contentious issues arising in the course of the tax audit or on the various claims which are made by an assessee. So the tax auditor should document those issues, the decision taken on those issues, the judicial precedents, if any, which have been relied upon for deciding on that matter. Along with that, the notes, the auditor should also give certain notes to the 3CD. Basically, the notes to the 3CD would detail the critical issues and assumptions made by the tax auditor, the reliance placed on various judicial precedents, on the various claims made by the assessee. These notes can be annexed to the Form 3CD and should as a practice, should be uploaded online along with the 3CD. And as a practice, the auditor should also obtain management representation letters on critical issues and assumptions which are made during the course of the tax audit. Coming to the recent amendments to Form 3CD, the CBDT notification 82 of 2020, dated 1st October 2020, has inserted a new clause 8A in Part A of Form 3CD. The clause requires the auditor to report on whether the assessee has opted for taxation under 115BA, 115BAA or 115BAB. Now, basically, these sections are, these sections are an optional regime of taxation for domestic companies. This clause would as such apply only to domestic companies and not to any other form of entity. So in case an assessee is opting for 115BA, which is applicable to domestic manufacturing companies set up and registered on or after 1st March 16, or where the tax rate is 25%. Hello. Yeah. Under 115BAA, the section applies to existing domestic companies set up at any time, any existing domestic company which is opting for the new rate of 22%. And 115BAB basically applies to domestic companies incorporated on or after 1st October 2019 and commencing manufacturing before 31st March 23. The sections 115BAA and section 115BAB were introduced last year in September 2019 by the tax ordinance. These sections, they offer the assessee, the domestic company, an option to pay tax at a lower rate, at either 25%, 22% or 15% as applicable. This option to avail the lower rate is available once in the lifetime. It can be exercised for any assessment year, but it's available only once. So once the domestic company opts for one of these concessional regimes of tax, they cannot then withdraw their option for any subsequent assessment year. Now, in order to exercise this option of 115BA, BAA or BAB, the companies need to file a form 10IB, 10IC or 10ID as applicable to that section on or before the due date of filing the return. So in case an existing domestic company wants to opt for 115BAA for financial year 1920, then they are required, that company is required to file a form 10IC with the department on or before the due date of filing the return. Now, there could be a practical issue which arises on this account. The tax audit report is required to be filed 1 month before the due date of filing the return. Now, as such, for filing that form 10IC or 10ID, the assessee has the time limit up to the due date of filing the return, which is, this is 30th November I've written, now it's been changed to 31st Jan. So currently the due date for filing 10IC or 10ID is 31st Jan 21, but the tax audit report has to be filed by 31st December 2020. So in case the assessee has still not filed that form before filing the tax audit report, then the question arises on whether, what the tax auditor should report under this clause, whether the assessee has opted for taxation under that under the new regime or not. So in that case, a tax auditor can get a suitable management representation on the company's intention to either opt or not opt for that lower rate and then report accordingly. In case the assessee has already filed that form, then there is no issue as such. But in case the assessee has not filed that form until the date of filing the tax audit report, then you can get a management representation on that on the company's intention and report in that fashion. The next amendment is relating to clause 18 on depreciation. Now, to just give a brief background, in case of a company which is opting for the lower rate under 115BAA, that company, that option is available to that company subject to the condition that total income of the company shall be computed without any specified deductions or exemptions, including additional depreciation. So that company opting for 115BAA cannot claim any specified weighted deductions, any tax holidays, or additional depreciation under Section 32. That company which wants to opt for the lower rate also cannot set off any loss carried forward or depreciation from any earlier assessment year if such loss or depreciation is attributable to any of the deductions referred to earlier. So basically, if that company has any brought forward losses or any depreciation or any unabsorbed depreciation in any of which are carried forward from earlier years, and to the extent that loss or unabsorbed depreciation relates to any of these specified deductions or relates to additional depreciation of an earlier year, then that company would not be allowed to take that to carry forward that much loss or that much unabsorbed depreciation. And such a company would be required to claim depreciation under Section 32 in the manner as may be prescribed and not as per the current rules.
ना मेरा है ना राम मारुति रोड के आरडी कर राम मंदिर रोड के आरडी कर खाली रोड रोड रोड
Hello. Another thing that such loss or depreciation which is not allowed to be carried forward shall be deemed to have been given full effect to, and no further deduction of such loss or depreciation would be allowed in any subsequent year. So basically, if there is any carried forward loss or unabsorbed depreciation, which so much of it that is relatable to the specified deductions or exemptions would not be allowed to be carried forward and would lapse in the year in which we exercise the option for the lower rate. Now, in order to give an incentive to companies who would want to go for the new rate, but who had who had substantial losses or unabsorbed depreciation, which would otherwise get lapsed, a one-time benefit was given to such assessees in the manner that any depreciation allowance in respect of a block of asset which has not been given full effect to prior to assessment year 2021, for such cases, a corresponding adjustment would be made to the WDV of such block in a manner as may be prescribed, provided that the option for the new rate is exercised in financial year 1920 itself. So if that company adopts the new rate in financial year 1920, that's the first year, if that company adopts the new rate in the first year itself, then in case there is any depreciation allowance which has not yet been allowed to the assessee, would be allowed by way of making an adjustment to the WDV. Now, the CBTT notification, which came recently on 1st October, they made an amendment to the rule, to Rule 5, which is the Rule 5 prescribes the rate of depreciation. So an amendment was made to Rule 5 to say that first, for this point, that that company can claim depreciation only in the manner as may be prescribed. So for those companies any company opting for the new rate for the 115BA, BAA or BAB, the maximum rate of depreciation on any block of asset has been restricted to 40% on the WDV of such block. So basically it means that in case of any block of asset where the depreciation is more than 40%, the rate would be restricted to 40%. Now, and other in for those blocks where and otherwise the depreciation rate would remain as it is as per the new appendix 1. But only in cases where the rate which is available to which is otherwise available to a company which is not opting for this new rate, if it is more than 40%, for a company which opts for this concessional rate, the rate would be restricted to 40% only. You would not get depreciation at more than 40% on the WDV. Now, coming to the benefit which we talked about in this proviso, for any company which opts for the new rate, which opts for 115BAA in financial year 1920 itself, and that company has a depreciation allowance from any earlier assessment year or any allowance of unabsorbed depreciation which is attributable to additional depreciation. So for example, if some company had claimed additional depreciation in the earlier years and they were not and they were in a loss position in that year, so whatever was so then that loss was basically business loss as well as unabsorbed depreciation. So that part of the unabsorbed depreciation which related to additional depreciation, which was on account of claiming that additional depreciation under section 32, would now be and which otherwise would not have been allowed to be set off under 115BAA because of this restriction. So now what they are saying, what the CBDT has clarified is that the WDV of that block of asset as on 1st April 19 shall be increased by such depreciation or unabsorbed depreciation which has not been allowed to be set off. So for example, if my unabsorbed depreciation, which is attributable to additional depreciation as on 1st April 19 is say 100 rupees, and the WDV of my block, so additional depreciation is basically on your plant and machinery. So the WDV of my plant and machinery block as on 1st April 19 is say 1000 rupees. Now that WDV has we have arrived at that 1000 rupees WDV after adjusting that additional depreciation that has already been reduced from that block. So my block is lower to that extent, but I have not got a deduction for that unabsorbed depreciation as of now, since I still don't have enough profits to absorb that entire depreciation from the past years. So what the rule says now is that 1000 rupees WDV will be increased by such unabsorbed depreciation not allowed to be set off earlier. So the 1000 rupees WDV, I will add the 100 rupees unabsorbed depreciation on account of additional depreciation only. I'll add that, and my new WDV, the revised WDV, will be 1100. And going forward for financial year 1920, I will get depreciation under section 32 on the WDV of 1100 instead of 1000. This option, so basically they are it is a benefit which is being given to that assessee who would otherwise, where otherwise that 100 rupees would have lapsed if because I am opting for the new rate. Ideally, as per the section, that 100 rupees unabsorbed depreciation would have lapsed and I would have never got it in any succeeding year. But as a benefit, if that company opts for the new rate in the first year, financial year 1920 itself, then the WDV would be increased by the amount of unabsorbed depreciation which would otherwise lapse and which is attributable to additional depreciation of an earlier year. and henceforth going forward I would get depreciation and normal depreciation under section 32 on 1100 instead of 1000. So to give effect to this change in the rule, they have amended the clause 18 of form 3CD. So earlier, so this was the format of clause 18, where we gave the description of assets, rate, opening WDV, addition, sales, and VAT during the year, and the amount of depreciation. Now, a new subclause CA and CB has been inserted in clause 18 in respect of companies which are making so under clause CA we are required to make the report the adjustment made to the WDV under section 115BAA. This is applicable only for assessment year 2021 and not henceforth. So if the company opts for the new rate in the next year and they still have some unabsorbed depreciation, then that unabsorbed depreciation would lapse. And so we report the adjustment made to WDV. So in that example, we report 100 rupees in CA, and under CB, we have to report the adjusted WDV, which will be 1100. So this is the amendment that has been made to clause 18 on account of the rule, the amendment to rule 5 on depreciation. Corresponding changes have also been made in clause 32A, which under which we report brought forward losses or unabsorbed depreciation. So now because of opting for 115BAA, ideally if there was any brought forward loss or unabsorbed depreciation which was attributable to any of these specified deductions, then that much amount of unabsorbed depreciation or losses would lapse, and that company would not be able to claim it again in any subsequent year. So to give effect to that, they have amended clause 32A of the 3CD, where we are now required to report whether the amount of brought forward loss or unabsorbed depreciation as per the return, then we are required to report all losses or allowances which are not allowed under 115BAA. So basically, if there is any brought forward loss or unabsorbed depreciation which relates to all those specified deductions, or which relates to any additional depreciation claimed in earlier years, then that amount would no longer be allowed in any subsequent year. So we need to report that amount which is not allowed here, and then amount as adjusted by withdrawal of additional depreciation on account of opting for 115BAA. So here we would report the amounts which as adjusted because of this proviso. So here we have added 100 to the WDV. Like in our example, we added 100 to the WDV, and we are now claiming depreciation instead. So our claim of brought forward of unabsorbed depreciation reduces to that extent. So then we are required to report that amount which we have adjusted under clause 18. And finally, the amount as per the assessment order. So so basically here we then find out the figure of the figure of brought forward losses and unabsorbed depreciation which still remains after making these adjustments in case of a company which has opted for the new rate. Now this would mainly be applicable only for BAA, 115BAA, because these 115BAA is for existing companies. 115BAB is for any company which was incorporated on 1st October 19. So as such, they would not have any brought forward losses or unabsorbed depreciation. So therefore, this clause, this amendment would not apply to companies opting for 115BAB. and mainly relates to any existing domestic company which is opting for 115BAA. So, should we stop for any question, if anybody has any questions, or should we take it up at the end?
Questions at the end.
Okay, all right. Yeah. So now moving on. So these were the amendments which were made in the recent CBDT notification. Moving forward to some of the critical aspects of various clauses of Form 3CD. So in this, I have tried to cover some of the important clauses which affect the taxable income of an assessee. So basically clause 13, which relates to ICDS, certain clauses like clause 18 on depreciation, 43B, which is clause 26 and so on, which all affect the determination of taxable income of an assessee. So starting with clause 13, which under clause 13, we are required to report on the system of the method of accounting adopted by an assessee and any deviation from the income computation and disclosure standards, which is ICDS. So now under section 145 of the Income Tax Act, assessee is an assessee who has any business income or income from other sources can opt for either cash system of accounting or mercantile system of accounting. So under clause 13A to 13C, we are required to report which method of accounting the assessee has adopted, either cash or mercantile, and whether the same is consistent with the method that was followed in any preceding year. In case there is any change in the method of accounting, then this would you would need to know whether what was the reason for that change. You would, as a tax auditor, you would be required to inquire about the reason for that change. Under clause 13D to 13F, we are required to report whether there are any deviations in the profit or loss, in the deviation in the profit on account of vis-a-vis the ICDS, and we are required to report the disclosures which are required under the ICDS. Now, the ICDS were notified with effect from assessment year 17-18. It applies for the computation of income under the head of profits and gains of business or profession, or for income from other sources. So the ICDS as such does not apply to income under any other head. Like it does not apply for computation of capital gains. The ICDS are applicable to all assessees who follow the mercantile system of accounting, except for individuals and HUFs who are not required to get their books of accounts audited under 44AB. So basically, if an assessee is following cash system of accounting, be it any assessee, ICDS would not apply. But if an assessee is opting for mercantile system of accounting, then ICDS would apply to that assessee, except for an exception has been carved out for individuals and HUFs who are not subject to tax audit. So if for example, if a sole proprietor is has adopted the mercantile system of accounting, but is not subject to tax audit, then the ICDS would not apply to that sole proprietor, and his income would be computed based on the normal provisions of the Income Tax Act. So the entire objective of the clause 13D to 13F is to determine whether there is any impact on the profit or loss of an assessee on account of any deviation from ICDS. So the accounting would be done based on the accounting standards adopted by that entity. But ICDS would have certain different adjustments which would be required to be made to that profit or loss in order to arrive at the correct taxable income. So in case there is any deviation between the profit or loss as per the financials and the profit or loss which should be there as per ICDS, then that impact would be reported under 13B and 13E as an increase or decrease in profit. And under 13F, we would provide information relating to disclosures required by the various ICDS. So what all items would need to be taken care of? You would need to examine the financial statements of an assessee carefully to identify areas where the treatment as per the accounting standard or the Indian accounting standards would vary compared to the provisions of the relevant ICDS. For example, if we take for example valuation of securities which are held as stock in trade. Now, under the accounting standard, the valuation may have been done on a script-wise basis, but the ICDS prescribes that the valuation of the securities which are held as stock in trade have to be done based on the bucket system. So basically all equity have to be clubbed together and only then we work out the valuation gain or loss. And all debt securities would be clubbed together. All government securities would be clubbed under a different bucket. But whereas under the accounting standard, we may have done a script-wise calculation of the valuation gain or loss. Then in that case, there would be a deviation between the valuation loss as per the accounting standards, as per the financials, and the valuation loss which is allowable as a reduction based on the provisions of ICDS 8. So any deviation in that would need to be reported as a increase or decrease in profit under clause 13. There could be certain mark-to-market losses. Now, any mark-to-market loss or expected losses are not allowed as a deduction as per ICDS 1. But under the accounting standards, the financials would be prepared on a prudence basis. So there could be certain expected losses or MTM losses which are debited to the P&L account, but which may not be allowed as a deduction under the Income Tax Act because of the provisions of ICDS 1. Then those adjustments would need to be reported, would need to be identified and reported under clause 13. Likewise, there could be ICDS 4. It recommends that the revenue be recognized on services based on the percentage of completion method, the POCM method. But it may be that the books of accounts follow the completed contract method. Then there would be a deviation in the revenue recognition to that extent, and any plus minus on account of that would need to be reported under the under clause 30 as a deviation from the ICDS. The technical guide on ICDS issued by the institute is a useful guide to understand and implement the provisions of ICDS properly. Coming to clause 14, which talks of the inclusive method of accounting. Now, if you see section 145A of the Income Tax Act, it prescribes that all the valuation of purchases, sales, and of inventory. So purchase and sale of goods and services, as well as the valuation of inventory, has to be done based on the inclusive method of accounting. So basically under that, they say that all taxes which are attributable to that purchase or purchase of goods or sales of goods and services have to be added to the value of the purchase or sales. And whereas under the books of accounts follow the exclusive method of accounting, where the purchases and sales are reported net of taxes, and the tax component, that is the input tax credit or the output tax, is shown as an asset or liability, as a receivable or payable in the balance sheet. So now, on account of this, clause 14 of 3CD requires us to disclose the method of valuation of closing stock employed by the assessee in the books of accounts and give the impact on account of the deviation from the method prescribed under 145A, which is the inclusive method. Now, ideally, in the GST era, there should not be any deviation whether we follow exclusive method of accounting or inclusive method of accounting, because even if so, like under the GST era, so in case of any ITC on purchases, a company would say if they've paid the purchase of any GST on their purchases, then they would get a credit of that immediately. The credit of that is not, the credit of that ITC is not related to or correlated with the sales of the finished goods. So basically, if I've paid ITC today, then if I've paid GST today on any purchases, then I get a credit for that immediately. And likewise, if I have collected any GST on my output, on my sales of finished goods or on my sales of services, then the same is paid to the government after adjusting any ITC available. So as such, there is no timing difference as such between when and when the ITC is availed and when the ITC is utilized. So as such, under the GST era, there should not be any deviation between whether we follow the exclusive method of accounting or the inclusive method of accounting. However, as per since there is a requirement in Form 3CD to report on any deviations and if any between the books and tax, between exclusive and inclusive method, we are required to then show a reconciliation between between the profit as per books and the profit as per tax, if we follow the inclusive method of accounting. So while preparing this disclosure, there is a format which is prescribed under the tax audit guidance note issued by the institute. Now, this clause reports basically any purchase or sale of goods. It includes even purchase and sale of services. So any taxes which are related to any services are also required to be reported under this clause now. It basically talks about reconciliation between any expense on the revenue, any expense or sales. So only on items which are affecting the P&L account. And hence, if there is any taxes, any GST which is paid on capital expenditure is not required to be considered. So you would need to maintain a proper reconciliation between your total GST input and the total GST and the amount of GST that is considered on your goods and services under clause 14. The related clause, clause 27A, goes hand in hand with the reporting under clause 14. So under clause 27A, we are required to report the amount of SENVAT availed or utilized during the year, and the treatment of that outstanding SENVAT in the books of accounts. So now under the when the assessee follows exclusive method of accounting, the GST receivable, the GST ITC will be recognized as a receivable in the books of accounts, and as and when that ITC is utilized, the receivable account will get credited, and as such that availment or utilization does not have any impact on the P&L account. Now under this clause, we are required to report the total amount of opening balance of ITC as per the GST records, add or less any ITC availed and utilized during the year, and give the closing balance of ITC as per GST records, and then show a reconciliation of the closing balance with the ITC available as per the books of accounts. Corresponding to this, we are required to show the treatment of each item of ITC in the books of accounts. So any item, the balance of ITC, opening balance, availed, utilized, and closing balance of ITC as per GST records, these entries are not routed through the P&L account. The final closing balance of ITC only would be available under the current assets in the balance sheet. And as a tax auditor, we are required to maintain a reconciliation between the ITC as per GST records, so which is appearing in the electronic credit ledger or electronic cash ledger at the end of the year as on 31st March 20, and the balance which appears in balance of ITC which appears as per the books of accounts as on 31st March 20. So these figures would also be reconciled with clause 14. Now this, the ITC here is the total figure of ITC, including revenue, including the ITC on revenue items and ITC on capital items. There would be a reconciliation maintained with clause 14, wherein we report only the ITC on revenue items. And now there is always a question. Practically, if you see the Java utility of the 3CD, there is the wordings of this clause have not yet been changed. The wordings are still we are required to report only SENVAT credits availed or utilized. Now SENVAT basically refers to only excise duty and service tax. And but if we see the Java utility of Form 3CD, the Java utility says SENVAT or GST ITC specifically. So because of that clause, there used to be there was always a confusion on whether we are required to report GST figures at all. But now since the Java utility prescribes SENVAT or GST ITC, it is advisable to report the GST figures as well under this clause, so that you know, the same, it goes hand in hand with what is reported under clause 14. Moving on to the other clauses, clause 17. Clause 17 is for any valuation of immovable property under section 50C or under section 43CA. So now under this clause, it deals with reporting on transfer of any immovable property, which is either land or building or both, during the year for a consideration which is less than the stamp duty value of that property. So the objective behind clause 17 is that it facilitates the computation of capital gains under section 50C or section 43CA. 50C is where the land or building, the immovable property, is held as a capital asset, and 43CA is applicable where the immovable property is held as stock in trade. So the tax auditor is then required to disclose the details of the properties transferred, the consideration received or accrued, and the stamp duty value for those properties. And this reporting under clause 17 is required only if the consideration on the transfer is less than the stamp duty value of the property. The stamp duty value can be obtained by calling for the by looking at the ready reckoner, the stamp duty ready reckoner rates for that property, and or by obtaining any certificate from an independent valuer. Now, various issues also arise on what constitutes immovable property. Where there are any leasehold rights or development rights, or say TDRs, transferable development rights, or any FSI which is transferred in relation to a land or building, then the question is whether this would fall under the provisions of 50C or not. There are various contrary views on this topic, and as such, the tax auditor would need to evaluate this based on the facts of that case and the relevant judicial proceedings. And it is the tax auditor can also consider then putting a note in the 3CD based on the conclusions that have been arrived at. So, but it's very important to remember here that this reporting is required only if the consideration on the transfer, the actual consideration, is less than the stamp duty value of the property. Coming to clause 18, in addition to the earlier discussion on this topic on depreciation, there are various other aspects in clause 18 which requires attention of the tax auditor. So one is confirmation of the ownership and actual use of the asset by the assessee. So depreciation is allowed only if that assessee is the owner of the asset and has actually used that asset for the purpose of business or profession during the year. Now, there is always a difference between the books of accounts follow the concept of ready to use, but the Income Tax Act follows the concept of put to use. So now there's always, there could be certain mismatch between an asset which is considered as ready for use for accounts purpose, but the asset may not be actually put to use for income tax purpose, and as such depreciation would not be allowed under section 32 until that asset is actually put to use. So it is very important for the tax auditor to verify whether that asset is actually put to use by the assessee. So for example, there may be some building which has been acquired or some rights which have been acquired by an assessee, but in one of our cases there was a court order against using those rights against the company for which where the court had stayed the purchase transaction, and they had put an embargo on that assessee for actual use of that asset, for actual use of those rights, to be able to derive the benefit from those rights. So in that case, it was decided that since the asset is not actually put to use by the assessee, then depreciation could not be allowed on on those rights. Another aspect that would need to be checked properly is the classification of asset based on the predefined blocks. The blocks are defined in the new Appendix 1 under the Rule 5 of the income tax rules. So we have to ensure that each asset has been classified under the proper blocks and the corresponding depreciation rate has been applied on that block as per the new Appendix 1. In case of assets, in case of plant and machinery, new plant and machinery where we are claiming additional depreciation, the tax auditor should satisfy himself that the conditions for additional depreciation have been complied with. That, for example, that the asset is not a second-hand asset, it is not used in any office premises, etc. So all those conditions should be satisfied, and only then the benefit of additional depreciation should be granted to that assessee. For this purpose, it may be that the tax auditor can, where the transactions are voluminous, the auditor can also get a management representation that the conditions for additional depreciation have been satisfied for each of those plant and machinery. It is important here, therefore, to scrutinize the fixed asset register properly, which would help in clause 18, and it would also help in several other clauses such as clause 19, which is on weighted deductions. It would help in clause 24 as well as clause 34 on TDS. Another important part of clause 18 would be to check if there is any 43A adjustment which is required. So basically, if the assessee has any imported asset which has been acquired for which there is a foreign payable, or which has been acquired through a foreign borrowing, then in that case any exchange gain loss on the actual payment of that on the actual payment for that fixed asset should be adjusted in the block of the asset itself. So basically the conditions are that it has to be an imported asset, there has to be a foreign payable or a foreign borrowing in respect of that imported asset, and thirdly there should be an exchange gain loss on actual payment of that asset at the time of actual payment of that asset. So any gain loss from the date of purchase up to the date of payment would be adjusted in the block of that asset, and it would not, which would otherwise under the accounting standards it would be debited to the P&L account, but for income tax purpose it would need to be added or reduced from the block of asset, and the depreciation would be adjusted accordingly. Another important point in relation to fixed assets is we should verify if there are any subsidies or any grants or reimbursements received towards the acquisition of any fixed asset, if directly or directly from the central or state governments. If there is any subsidy which is directly or indirectly related to a fixed asset, then that entire amount of subsidy should be reduced from the cost of such asset, and depreciation would be allowed only on the net cost of that asset, which if a company was following say Ind AS, then that would not be the case. Under Ind AS the subsidy would be taken to the P&L account instead of being adjusted against the cost of that asset, so there would be a mismatch to that extent. So for income tax purpose it would still need to be reduced only from the cost. One more point was regarding the one amendment which was there in new Appendix 1 in respect of motor cars. Any motor cars which are used for other than hiring business, which were acquired on or after 23rd August 2019, but before 1st April 2020, and also put to use before 1st April 20, these cars, motor cars, would be eligible for depreciation under Section 32 at 30% instead of the current rate of the normal rate of 15%. So this benefit was granted last year only for motor cars which are purchased during this specific period, and as such it applies only to motor cars purchased here and not henceforth. The clause 19 on weighted deductions. Now, under clause 19, we report various weighted deductions and any other admissible deductions from business income. So basically any deductions for scientific research and development expenditure under Section 35, any amortization of preliminary expenses or amortization of merger demerger expenses would be reported under this clause. The tax auditor is required to indicate the amount debited to the P&L account and the amount that is actually admissible as per the provisions of the of that particular section. Now, one important point on this clause is in case an assessee is opting for 115BAA or 115BAB, that is the new regime of tax for this year, then that company cannot claim any of the weighted deductions or exemptions, such as any of the weighted R&D expenses, any investment allowance under 32AD are not available to such assessee. So in case the assessee in case that assessee is a domestic company and they give a declaration that they are going to opt for the new rate, under 115BAA or BAB, which is now, as we discussed earlier, it is now reported under the new clause 8A. So in case the assessee provides a declaration that they're going to opt for that new rate, then the tax auditor must take care that no amounts are reported against the deduction specified in clause 19, because these deductions are not available to an assessee who has opted for the new regime of taxation. So for this purpose, a suitable note may again be given in the notes to 3CD to that extent. Coming to clause 21, clause 21 discusses about various the disallowance of various expenditure while computing taxable income. So we are required to report on any expenditure which is in the nature of capital expense, personal expense, any advertisements, fines, penalties, any interest, etc., which is debited to the P&L account and which is not otherwise allowable as a deduction. For this purpose, we should scrutinize all the ledger accounts of expenses for any capital items which have been booked as revenue, or any personal expenses or any fines and penalties of a penal nature, which are charged to the P&L account. Now, for example, there's always a issue on whether any interest which is paid on taxes, interest on GST, or say any interest for late filing, any late filing fees, any penalties for late filing, which have been charged to the late filing of returns, which have been charged to the P&L account, and whether such expenses would be allowed as would need to be reported under clause 21 or not. Now, there are various judicial precedents on this which say that such interest or such late filing fees are of a compensatory nature and not really penal in nature. So they don't need to be disallowed. So the tax auditor, based on the facts, he can consider whether to report such interest or such late filing fees under this clause. Coming to disallowances under section 48(3), read with rule 6DD. Now, for this purpose, the limit for the threshold for cash payments per person per day was earlier 20,000, and over the last couple of years has been reduced to 10,000 per person per day. For this, we should scrutinize the cash ledger carefully, and in case of any exceptions, in case of any deviations from the rule of 10,000 per person per day, we should verify whether those deviations are covered within the exceptions which are listed under rule 6DT. If not, that entire amount of expense would get disallowed and would not be allowed as a deduction to that assessee. In case of another important clause, which is relevant, maybe the last year for this clause, disallowance would be financial year 1920. For it pertaining to disallowance under section 14A, read with rule 8D. So now, in case the assessee has any exempt income, such as dividends or any interest on tax-free bonds, any share of profit from partnership firms, etc., then if any income has been, such income has been claimed as exempt by the assessee, and in case the assessee has incurred any expenses in relation to earning that exempt income, then such expenses would get disallowed under section 14A. Now, from financial year 2021 onwards, dividends have become taxable. So, any expenses incurred for earning dividend income would not be affected from financial year 2021 onwards. But for financial year 1920, and which is the current assessment year 2021, we would need to check whether any expenses have actually been incurred by an assessee for earning any exempt income earned during the year, and if such expenses are not directly ascertainable, then we could work out the proportionate expenses based on a proper scientific allocation for the purpose of disallowance under 14A. So now, if such expenses cannot be ascertained, then the disallowance can be determined as per the formula prescribed in Rule 8D of the income tax rules. So the Rule 8D prescribes that 1% of the annual average of the monthly average of the investments should be considered as a disallowance under Section 14A. So now the computation of disallowance under 14A would depend on the facts of the case of the assessee, would depend on the various stands which are taken by the assessee. It is, as such, this issue is subject to a lot of litigation, and based on whatever stand that the assessee is taking and the tax auditor is taking, based on various judicial proceedings on that issue, then those facts, those assumptions and judicial precedents can be mentioned by way of a note to the 3CD. Now, there could be various standpoints for, there are various issues which arise for computing this disallowance. For example, whether strategic investments are required to be considered while determining the amount as per Rule 8D. So there is a Supreme Court decision, Maxop Investments, which says that strategic investments and any investments which are held as stock in trade should be considered for the purpose of calculating the 1% of average investments under Rule 8D. Then there are certain other Supreme Court decisions which say that in case any investment, in case any particular security does not yield any exempt income during the year, then no disallowance should be considered in respect of that security. So that security can be excluded while calculating the 1% of average investments. Now, this again depends on what are the facts of the case of that assessee, and the final, so these facts and the reliance which is placed on various such case laws should be mentioned in the notes to the 3CD. Another one of the other important clauses of this clause 21 is subclause I, which relates to any amount of interest expense which is inadmissible under section 36(1)(3). So basically here, if the assessee has taken any loan for the purpose of acquiring an asset, then any interest from the date of borrowing up to the date of put to use of that asset is required to be capitalized to the cost of that asset for income tax purposes. And in case any part of such interest has been debited to the P&L account, then such amount would be disallowed as a deduction and it would be added to the block of the asset instead of being allowed as a revenue expenditure. So it is important in case of specific borrowing, or in case of even in case of general borrowings, we can make a reference to ICDS 9 on borrowing costs to decide whether any interest expense is required to be adjusted in the block of the asset or not. Into disallowance under section 43B. 43B of the Act, it provides for allowance of certain specified expenses only if such amounts are actually paid during the year or paid on or before the due date of filing the return for that year. So in case here under this clause, we are required to report on any allowances or disallowances of all specified expenses based on verification of the actual payment. Now, there are two parts to this clause. One is clause 26A, which relates to expenses disallowed under 43B in the past assessment years. So that is any disallowances which pre-existed on the first day of the year. So, for example, in our current year, any disallowances which pre-existed as on 1st April 19, which are paid during the year and which are not paid during the year and still and continuing to the next year now. So in case, so under clause 26A, we are required to report if any expenses which were disallowed in earlier years have been paid during the current year, and if any expenses which are not disallowed, which were disallowed in the earlier years and are still remaining as unpaid at the end of the year. For this purpose, payments made during the year only are considered. The time limit for the payment for any past disallowances is only during the financial year. If those payments are made before filing the return, then those payments are not considered. So if I have any existing disallowance on 1st April 19, and for which I have made payment during financial year 1920 up to 31st March 20, only then can I claim a deduction of that item under 43B. If I have made that payment on 20th May 2020, then I will get a deduction for that in the next year. Coming to part 2 of clause 26, it pertains to any expenses which are pertaining to the current financial year. That is, any liability incurred during the current financial year and which is outstanding as on the last day of the financial year. Which is outstanding. So for in our case, any liability incurred during financial year 1920 and outstanding in the balance sheet as on 31st March 2020. Now, in such cases, in case we are required to report whether such liabilities have been paid on or before filing the return, or otherwise or not paid and outstanding and carried forward to the next year. So in case where the liability relates to the current financial year, then we have the time limit of up to the date of filing the return. In case the payment is made before filing the return, then we can allow it as a deduction under this clause. We can show it as a payment under this clause. So for example, if I had some payment outstanding on 31st March and I have made the payment on say 30th June 20, then I can still claim it as a deduction for financial year 1920 itself. Now, in this case, it is since the tax audit date has been preponed by 1 month. So the from 1 month prior to the date of filing my return. Now, for 43B, the time limit for claiming the expenses is up to the due date of filing the return. So there could be a mismatch between. There could be some items which we have disallowed, which since they were not paid before filing the tax audit report, and the tax auditor has disallowed those expenses, and the assessee may have made those payments before filing his return in the succeeding month, and he would claim that as a deduction in his return. So it is important for us as tax auditors to put a note in the 3CD that any payments or any payments toward outstanding liabilities are considered only up to the date of filing the tax audit report, and any payments after that are not considered. Yes. One of the important issues which is usually there in 43B relates to provision for leave encashment. Now, in the case of many assessees, the provision for leave encashment used to be claimed as a deduction, relying on the decision of the Calcutta High Court in the case of Exide Industries, and wherein the Calcutta High Court had said that the clause F of section 43B is not constitutional, and the provision for leave encashment is as such a trading liability which can be claimed by the assessee on accrual basis. Now, based on that Calcutta High Court decision, many assessees used to claim that deduction, and tax auditors used to usually put a note in the 3CD that the disallowance of provision for leave encashment is not considered, relying on the Calcutta High Court decision. Recently, in April 2020, the matter had gone up to Supreme Court, and the Supreme Court decided on this issue and said that leave encashment payable to employees is deductible only on payment basis. So, any reliance which was because of this Supreme Court decision, which has overruled the High Court decision, the Calcutta High Court decision now, the stand of the provision for leave encashment would need to be re-evaluated, and a proper disclosure would need to be made in the tax audit report on account of that. So, and in case there are various other issues also which arise in the interpretation of 43B, for which the auditor can give a suitable note in the 3CD by drawing support from all the relevant judicial precedents. Coming to clause 34 and the related clause 21B of the tax audit report, which relates to compliance with TDS provisions. Now, under clause 34, the tax auditor is required to report on whether the TDS has been correctly deducted and deposited within the prescribed time limits, whether the relevant TDS or TCS returns have been filed by the assessee within the time limits, within the due date, and whether the assessee is liable for any interest for any default in complying with the TDS provisions. So for this purpose, the tax auditor is required to scrutinize the financials and for all the expenses incurred by the assessee during the year, and whether TDS has been deducted correctly on those items or not, and then compare it with the TDS returns that have been filed by that assessee. Any non-compliances in deduction or deposit of such TDS would trigger the reporting under clause 21, wherein we are required to report on any whether any TDS was required to be deducted but was not deducted, or any TDS which has been deducted but has not been deposited. So two areas. One is not deducted at all, and second area is where it is deducted but the TDS has not been deposited to the government. So in case the payment, the consequence of reporting any item under clause 21 would be that if the payment is made to a non-resident and TDS is not being deducted, or TDS has been deducted but not deposited, then that entire amount of payment would be disallowed as an expense for that assessee. And in case of a resident, in case any payment on which TDS has not been deducted or deducted but not deposited, then 30% of that expense would get disallowed for that assessee. So for this purpose, since the scrutiny of the financials and the TDS returns directly affects the allowability of that expense, so we are required to make a proper analysis of the TDS provision, whether the TDS has been deducted as per the correct rates under the correct section, whether the low TDS certificates have been applied correctly by that assessee, whether any TDS on foreign payments has been done as per the form, as per the CA certificate obtained in form 15 CD. Then all those points we would need to look at carefully, and then report any non-compliances, if any, under clause 21. Now, practically in the case of many SSCs, it may be difficult to reconcile the expenses in the financials with the TDS records which are maintained by that SSC due to the voluminous nature of transactions. Now, because of this limitation, it may be difficult for the tax auditor to comment on whether the TDS has been deducted correctly or not, and whether the TDS compliances have been done properly or not by that assessee. In such case, the tax auditor can give a note to qualify the said clause in the tax audit report in the 3CD or in the form in the audit report in 3CA or 3CB. In case it is not possible to reconcile the expenses with the TDS returns. Coming to the last one on clause 31. Now, clause 31 basically talks about it's a reporting pure reporting requirement where we are required to report on any acceptance of deposits or on any acceptance of loans or deposits by an assessee and repayment of such loans or deposits in excess of the prescribed limits. So basically, in case any assessee has taken or accepted any loan or deposit exceeding rupees 20,000 otherwise than by an account pay check or an account pay draft or through banking channels or through electronic modes, then so basically if a assessee has accepted any loan or deposit in cash or then we are required to report such transactions under clause 31, because now any violation in under this of the provisions of section 269 SS, it attracts a penalty of an equivalent amount. So in case any so for this purpose we would need to scrutinize the records of the assessee to check whether any loans or deposits accepted during the year have been done through account pay checks or account pay drafts or through the ECS or through banking channels. Now, in most cases, practically it is not possible. There is no documentary, the assessees also do not maintain any documentary proof for whether even if it was with a check, whether it was an account pay check or if it was an account pay bank draft. So in such case, the tax auditor can put a suitable note in the 3CD saying that it is not possible to verify. And that we have relied on the management representation. That the payments or the acceptance has been done through an account pay check or draft or through banking channels. So now here we report one on acceptance, second we report on the repayment of such loans or deposits which were accepted earlier. The limit for reporting on any loans or deposits accepted is 20,000. But if any repayment of even 1 rupee out of such loans or deposits is made during the year, then those repayments are required to be reported under 31D or 31E, as the case may be. So the limit of 20,000 applies only to the acceptance of deposits, and the repayment of even 1 rupee of such deposits which exceed 20,000 have to be reported under the clause 31D or 31E. Then recently, in the last couple of years, this new clauses were inserted, new subclauses were inserted in clause 31, BA, BB, BC and BD. This basically relates to the new section 269 ST, where any receipt exceeding 2 lakhs in cash is not permitted. Any receipt from a person of by a person of 2 lakhs or more in cash from one person in a day or for one occasion is not permitted, and there is a penalty under 271 DA of an equal amount. So for the of an equal amount of the sum which has been received in cash. So under 31BA and 31BB, we are required to report whether the assessee has received any amount exceeding the limit specified under 269 ST. That is, if the assessee has received any amount of 2 lakhs rupees or more in cash from a person in a day, or in respect of a single transaction, or in respect of one event or occasion. And correspondingly, the reverse case, under 31BC and BD, we are required to report if the assessee has made payment to any person exceeding the limit specified under 269 ST. So we are required to first report the receipt of 2 lakhs in cash, and then even the payment of 2 lakhs or more in cash made by the assessee. So that was it from my side. If you all have any questions, I would be happy to answer those.
If anyone has any question, then they can unmute themselves and ask.
There is one question.
One
Yeah, there
question
is
is
one question.
Chat box.
Whether amortization of deferred expense or intangible asset will be allowed under section 115 BAA.
I'm sorry. Deferred expense of intangibles.
Yeah, whether
Hello.
amortization of yes, Jayna, am I audible?
Yes, yes.
Whether amortization of deferred expense or intangible asset will be allowed under section 115 BAA.
Yes, we can continue to claim depreciation on intangible assets under 115BAA. We just cannot claim additional depreciation. So any additional depreciation which applies basically only to plant and machinery cannot be claimed. But any other depreciation on all the other assets can be claimed.
Okay, thank you. Any participants wants to ask any question? Any other participant, then they can post in the chat box or they can unmute themselves and ask. Okay, if there are no further questions, then we can conclude, no, Charvik bhai?
yes, Raj, you can conclude.
Okay, okay. First of all, someone has put some question. Okay, sorry. So first of all, I would like to thank Jayna for the excellent presentation. In spite of the tax audit due date, which was on 31st of October, though it is extended today, she would have prepared this presentation the last week or so and spend a considerable amount of time in making this presentation and sharing it for the benefit of the members. So on behalf of the association, I thank Jayna for the excellent presentation and deliberation. Then I would like to thank the participants as well as all the office bearers and the committee members of the association for their participation. And I would request everyone to keep participating in the webinars organized by the association. And stay safe and stay healthy. And our next presentation slides and the video will be uploaded on the YouTube, and presentation will be mailed to the participants and on the WhatsApp groups also. So kindly keep in touch with us for the next webinar. We'll make the announcement through WhatsApp groups and emails. Yeah, thank you all for joining. Thank you, Jayna.
Yes.
Thank you, Jayna. Thank you.
Thank you.